Hi, Tim Bigham back this week from Delta Derivatives, Option Hedges and Edges, powered by the best option scanning tools on the market today, rbtrader.com, and looking at a market that certainly is lacking in some power here recently. We opened up higher this morning, are pulling back. Last I looked, S&Ps were negative on the day. Oil again weighing heavily. Oil, which was up earlier, came out with some inventory numbers that they didn't really like, so oil bringing the market down with it. Who knew that lower oil would be the cause for such concern? Obviously, that kind of pseudo tax break that everyone alluded to, not helping too much with spending and certainly not helping with the overall market. So going forward, be interesting to see what happens here. Oil getting deeply oversold. I think we may get, a bounce here. With 42 gallons in a barrel of oil, we're looking at oil at around $30 at about 70-some cents per gallon. You go to the store, water's about $1 a gallon, just to put that in perspective. So using those option scanners to again be a little more opportunistic than tactical, seeing some big call volume over the past couple days on JCI, Johnson Controls, big buyers in the April 39s and repeat buyer there. Also the Feb 37s yesterday. That set up a very nice calendar spread trade. We bought the April 37s at about a 29 vol, and because of the big buying in February, sold the Feb 37s at about a 33 vol, paid 50 cents for that spread. Was marking up a little bit here, leaning with that big call buyer, but again, hedging ourselves and looking to capture that implied volatility spike. I think going forward, the upside will be difficult at best here. Anyone who's been watching these videos for the past, 6 to 9 months know I have been less than enthusiastic with the market. We're finally getting down to a level where some put selling, I think, makes sense. And looking at the oil names, stocks like Exxon and Chevron, I think, are getting attractive here, structuring at about 1 standard deviation out of the money, out about a 2-month time period. You have high yields on these stocks, Exxon over 4%. Anytime you have big yielders, the puts are comparatively more expensive than on stocks that don't yield that amount. So by selling some out of the money puts, you're able to capture, that, if you will, kind of juicy dividend. Also implied volatility on these oil names at recent highs here. So able to get a little bit further out of the money for the same net credit. I like that double combination here. And with oil somewhere around 30, unless you think oil's going to zero, these names may get a pop here. Exxon does not hedge its exposure going forward. They also are integrated. They are, upstream, midstream, and downstream, all three. So the refining side of it getting the benefit of lower oil prices. So until next time, this is Tim Bigham, and especially in this market environment, keep those position sizes in place and those stops going. Take care.